So I say let's go ahead and get cranking on this. Welcome everybody. I appreciate you guys being here this morning, and I'm excited to get into this topic. Mike and I actually had an opportunity to talk a little bit about it yesterday. This mortgage insurance, making sense, being able to utilize that tool with your real estate business, and that's the important part of this, you guys, is to recognize that it's, there's some probably bad press out there about mortgage insurance that we all kind of, hold up the garlic and stuff like that. So, but it's, but there's definitely some value to it. So I'm not going to I don't want to steal any of what Mike is going to be talking about. Just a couple things that I wanted to mention to you guys real quickly. First of all, thank you for being here. Number two, appreciate you taking the time. And then, make sure you're utilizing the chat box. I mean, we have everybody muted on purpose, not to keep you from being able to participate with your voice, but because the background noise with that many participants can be, overwhelming and take away from the value of what we're going to get out of this. So with that, please take advantage of the chat box. I think everybody sees it, knows it's there. So as you have comments or questions as we go through the presentation, please take advantage of utilizing that. Okay, I would really appreciate it. The other thing too is this is going to be available on, once we're done with this presentation, this is going to get posted on citybishopworldwide.com/Mike Ott. Okay, so you're going to be able to find his page, and this video will be on that page. And I will also make it available to Mike. So if he wants to send it out to you, he can send it as a link to a YouTube video. But what I'm leading into is, geniuses take notes. So take an opportunity, take some notes as we go through this, and pick up some, because what I found is taking notes, a lot of times you're going to get the ideas and what they mean to you specifically. So, definitely take advantage of that. And the other thing too is that friends share stuff. So once you see this video, you have it available to you, there's other people that that may benefit from it, please make sure you take an opportunity to share it with others, okay? So with that, I don't want to take away from Mike Ott, and I wanted to make sure that he has an opportunity to give this presentation full heat. So Mike, give the floor to you, sir.
Thank you, Dave. Appreciate it. Good morning, everybody. My name is Mike Ott with First Heritage Mortgage, and this webinar titled Mortgage Insurance Making Sense, and yes, the pun is intended on sense. We want mortgage insurance as one of those misunderstood things with, home buyers and agents. So for those of you that haven't done a live class with me, or you heard a bit about my background, I was a public school teacher in middle school, and I actually taught English language arts. So the pun on sense is right up my alley, and I feel absolutely, at home here, kind of in the classroom environment. So the subtitle here is The Bridge to Low Down Payment Mortgages, and the thing about mortgage insurance is that there's some myths or some misconceptions out there, and I'm sure you guys as agents hear this all the time from prospective buyers, the ones that kind of sit on the sidelines and the fence sitters and say, well, I don't think I can buy because I don't have 20% down. And you yourselves probably know that, yeah, there's other low down payment options. But then they kind of follow up, well, I've been told I don't want to pay this PMI, this private mortgage insurance, and the, like David mentioned, they start waving the garlic and putting up the cross, and, the PMI is the devil, when really it's the bridge to low down payment mortgages. And as you'll see from this presentation, it does favor and is more affordable for your high credit borrowers, and it's much more easier to utilize some of the different flavors. That's kind of the theme here, is that mortgage insurance can be paid a couple different ways, and the number one misconception is that it has to be paid monthly, and that's not really the case. So we'll jump right in here. I'm going to get to this next slide. And first of all, let's kind of dial back and think, well, where did this concept of mortgage insurance come from? Essentially, it came from the grandfather of mortgage insurance, which was the FHA loan. Basically, the government kind of wanted to, hey, we want to make home ownership possible for more people and for low to moderate income households. How can we start to offer lower down payment mortgages? And how can we incentivize the lenders to actually do these loans? Well, enter the concept of mortgage insurance premiums and the monthly mortgage insurance for FHA. That's, one of the things that when a borrower gets an FHA loan, they pay actually two forms of mortgage insurance. They're going to pay an upfront premium, which is currently 1.75 if they're doing the minimum 3.5% down. And then they also pay a monthly mortgage insurance premium, which is 85 basis points of whatever the base loan amount is. Now, that's usually kind of the downside, and that's kind of, I think, where mortgage insurance in general gets its misconception that it must always be paid monthly and, it's going to make my payment higher. Well, with FHA, both of those are true. It does have to be paid monthly, and it's inherently going to make the payment a little bit higher if you compare it to a conventional loan with a low down payment and perhaps one of these other options that we're going to explore today where maybe you don't pay it monthly. So after FHA set the table with their mortgage insurance menu, private mortgage insurance enters the marketplace, and that's what PMI is the acronym for. And PMI is attached to the conventional loan programs. And they basically take a look at a lot of factors, but the two most important that you can see from this matrix on this screen is that they consider credit score and then the loan to value. Essentially, how much is the borrower putting down? So you see there across the top of the matrix, you've got basically in 20-point increments, credit score buckets. Over on the left-hand side, from top to bottom, you've got your loan to values. Essentially, that first row across is 97%. So that's somebody putting 3% down on a conventional loan, 5%, 10%, and then 15%. Right. And then obviously, 20% down, we're not even having this discussion, but the point of the chart is just to show you that, the higher a borrower's credit score is, the more affordable the PMI is for the loan. Now, this chart happens to be a snip from one of the mortgage insurers who, this is an example of a single premium. So when you see those numbers, like you think, okay, if you look at the 97% column going across, and you look at, let's just say this, the 760 plus credit score, and 35% coverage is the base requirement. You're thinking 1.58%. Well, it's 1.58% in this case as a one-time fee, not a monthly fee. If that were monthly, that'd be outrageous. But just so you know, and we'll see more about the difference between single premium, paying it monthly, and then we've got some other ways to structure it as well. We can finance it, or you can have lender-paid mortgage insurance. So basically, in a nutshell, it's all risk-based, and my little red print there at the bottom is kind of, putting it plain and simple. The higher the credit score, the less expensive the premiums. The more money down or the lower the LTV, then the less expensive the premiums are. So the number one common misconception is that it must be paid monthly. So what I've done here is I've put two side-by-side matrix from the PMI. I'm showing you again that sample single premium MI chart on the left, and then on the right, we've got the monthly premium MI chart. And I'm going to move my little video so that I can see this one better. So you'll notice that, yes, it can be paid both ways, but what I point out on this slide here is that in conventional financing, you really have to be mindful of where the borrower's credit score is. And on the monthly side there, on the right-hand side, you see I've circled two little premium costs, one in the 97 row at 0.87%, where the FICO score is 720 to 739. And the reason why I circled that is because if FHA financing requires 0.85% in monthly mortgage insurance, the conventional loan right there is that's kind of the breaking point, where it almost says, well, hey, I use this chart because if I've got a borrower that, let's say, is a 720 to 739 score, I'm looking at this thinking, well, maybe they're better off with a little bit lower premium and maybe doing FHA financing. And this mortgage insurance and credit score and the way they risk-based price this could be the difference between my recommendation for, I think because of where your score's at, maybe you're better off and it's better financially for you to actually do FHA because the monthly mortgage insurance, is going to be a little bit cheaper. And the 95% loan to value row across there, you notice that I've dropped now down to the 680, 699 credit score bucket. And if the borrower were putting 5% down at a 680 to 700 score, they'd still be better off and better financially and payment-wise if they did the FHA versus the conventional loan. So essentially that monthly chart is pretty key in determining what might be the best financing. Should they go FHA or could they go, the conventional route? Now, one more thing about the single premium. So the single premium is essentially a kind of one and done. I like to call it the buyout. And obviously, as we mentioned on that first slide when we looked at this chart that's over on the left, the higher the credit score, right, the lower this premium is going to be. Now, what they do is they take that percentage and they apply it towards whatever the loan amount is, and then it becomes a single cost in the transaction. So who's it good for? It's good for the borrowers that have the money that can basically do the one-time buyout, and then obviously it's good for the high credit score borrowers who are obviously going to get the lesser expensive premiums. This slide basically breaks down, and we're going to kind of look at, because we've got buyers that are, usually they're always payment sensitive. So what I've done here is basically shown a $400,000 purchase we're doing 3% down, so they finance a loan amount of $388,000, interest rate of 5%, and the single premium payment is $2457.87 a month. And you look right next to it for the monthly MI version, same structures, still 3% down, interest rate's the same, but the payment's higher because if you look at the bottom graphic where it says payment breakdown, you'll see that the reason that payment's higher on the monthly is because there's $148.73 in monthly mortgage insurance tacked onto that payment. Now, the annotations to the right here, first, my assumption is we're doing this as if this is a borrower with a 760 or higher credit score. And we look at the numbers. So that one-time cost of the single MI is 1.36%. So what I do is I multiply that, right? We multiply that by that base loan amount, the $388,000. that gives us the $5,276.80 as a one-time charge to buy that out, which means going forward, if the borrower does this, there'll be no monthly mortgage insurance collected. It's being bought out, one and done up front. If the borrower chose the monthly MI cost, what I like to show my borrowers is I said, well, let's look at just the monthly cost and say the first 60 months of the loan. So I take that number, right? I take that $148.73 and I multiply that by 5 years or 60 months. So in the first 5 years, if that borrower chose monthly mortgage insurance, they'd pay $8,923.80. Now, what I'm trying to do in the math of the little equation below that is I want to find the dollar amount that is closest to my one-time buyout of the $5,276. And that would equate to 36 months of paying monthly mortgage insurance. And I come close, I'm a little bit high there at $53.54.28. And the reason for doing this calculation is I'm looking at it from this perspective. If the borrower stays in the house and keeps the mortgage for three years or more, right, there's a financial benefit to basically doing the buyout. And what I tell the borrower quite often is like, look, hey, in 5 years, chances are you're probably not paying down your principal balance on its regular amortization schedule to be anywhere near 78% loan to value, where by law, the mortgage insurance, the monthly mortgage insurance would go away. And you're probably not anywhere near 80% value where you can request it to be taken off. So again, anytime when cash is not a problem and we've got high credit, I typically like to encourage them for this single premium MI buyout, because I think, again, its financial benefits definitely outweigh the monthly. And again, you have to say, now this is a different story in this particular situation. If the person says, oh, hey, look, I'm military, I know I'm only going to be in this house for I'm here for two to 3 years, and then I'll be stationed somewhere else, but I want to buy, well, then maybe that makes sense. Of course, if it's military, they're probably going to do the VA loan and have the whole funding be, and that's a whole nother story. But if they opted for, somebody short term came in and said, hey, or look, this is my first house, this is just my starter home, I'm here 3 to 5 years max, then maybe it might make better sense to keep their cash to close less in the purchase transaction and pay the monthly, knowing that it's going to be a short term. So hopefully that kind of paints a more clear picture of, kind of seeing a side by side of the payment difference. Obviously it's going to be higher with monthly, but the better financial benefit longer term if they can afford to buy it out one and done up front. All right, so early takeaways. The MI can be bought out, right? And again, as I've said, that's usually the preferred method for your high credit score borrowers. Monthly is not the only option. The single premium MI could save thousands over the first 10 and 11 years. And I chose 10 and 11 years because that's usually the time it takes for the loan to naturally amortize down to 80 or 78% of the value, where the homeowner can say, hey, I want to get rid of this now, or if I'm at 78%, it goes away naturally by law. So for you as the real estate agent, the thing that I want you to be equipped with is that I want you to kind of use this information to dispel those two myths out there, like, oh, I need 20% down, because there are low down payment mortgage options. And in the conventional loan world, yes, you have to pay private mortgage insurance in some way, shape, or form. But the other secondary myth is don't don't let PMI scare you, and don't think that it automatically has to make your payment higher because you have to pay it monthly. And I see this quite frequently with the buyers that, what they do is if they're operating on these misconceptions, they're the ones sitting back saying, oh, well, I got to put off buying. I got to put off buying. And now all of a sudden the cost of waiting comes into play, right? Home prices keep going up. Rates might go up, right? So they could buy now if they had the proper knowledge and education and how to utilize, some of these financing options for low down payment mortgages with PMI in different forms other than just monthly. And that's kind of where we're going next. Talk a little bit about lender paid mortgage insurance. Lender paid mortgage insurance is slightly misleading, and the idea that the lender is going to pay for this out of the graciousness of their heart is probably not the case. What really they advertise this as a no MI type of loan. And those of you in Virginia, if you're familiar and you've had first-time buyers, you know that if they've used like a VHDA conventional product, there's a no MI version. And if you've noticed, if you kept an eye on this, that your borrowers that do that, they're typically paying a much higher interest rate compared to where the market is. And the reason for that is essentially lenders are using an above market rate because there's premium pricing or a rebate for that above market rate. And what they're doing is basically looking at, okay, what's the cost of the one-time buyout? And then where do I find that rebate on my rate sheet? So essentially, the borrowers who say, okay, yeah, I want to do this no MI or this lender paid mortgage insurance option, they're going to have to be comfortable with the higher interest rate and ultimately probably a higher payment compared to as if the borrower paid it. So the examples we looked at before, monthly and single premium buyout, were borrower paid examples. This lender paid, again, is essentially it's paid through the interest rate. So the thing to keep in mind when you hear no MI or lender paid mortgage insurance, you prep your buyer clients to say, hey, look, here's a way, that where you might keep your cash to close in the transaction lower by doing the no MI or lender paid mortgage insurance, but you're going to have to be comfortable and be able to tolerate, an above market interest rate because the lender's using that rebate or premium pricing on that particularly higher rate to actually pay the mortgage insurer for you. So again, it's still, when they say it's, it can be often misrepresented or, advertised improperly saying, like this is a no MI or no cost to the borrower. Well, that's not entirely true because with a higher rate, you got to think the buyer's going to have that higher rate for as long as they have the loan. So if the market rate's at 4% and the lender paid mortgage insurance is at 5%, that's a point higher in rate that's, attached to that mortgage note for that buyer, and they're going to have that for as long as they have the loan. So what I've found, though, is that the lender paid option, when I put it side by side and, like in the grid that's on this page here, that oftentimes the lender paid option is much less than, well, in this case, it's close. It's about $30 less if you look at the grid below. Still with our same $400,000, 3% down. So I showed you here 5.25 is the rate, and I put a little rectangle box around the lender paid option, right? So in comparison, it's a little bit less in payment, $30 less in payment when compared to the monthly option. Now, I would often tell people, as the mortgage lender, I would give this consideration because, and I always, we preface this just like you as a real estate agent, me as a mortgage originator, we cannot, give tax advice, but there is, one fact that comes straight from the mortgage insurance companies themselves is that, there is no more tax deductibility for mortgage insurance premiums. So if you're going to have slightly less payment on a lender paid option, despite the higher rate, your interest is still, part of the tax deduction equation. So the monthly MI that you'd pay on the middle column, they're basically saying, hey, there is no tax deductibility for that. So why not consider, hey, the higher rate, a little bit lower payment, and you still have your tax benefit of the mortgage interest for those that are able to itemize. It's just, again, one of those things where it's something to consider. So that kind of gives us kind of a stack up. You do the borrower paid MI buyout going from left to right, the monthly, and then the lender paid. And now the next slide is going to add one more flavor, if you will, and one more wrinkle to this. And this is the concept of financed MI. Bear with me a second and get my little screen put out of the way. So, financed MI. Now I'm introducing a new structure. So, PMI can be financed, but there's a couple of rules. On conventional financing, if it's a regular conventional finance, conventional loan, the maximum loan to value is 95%, which means the minimum down payment is 5%. However, if one or more of the borrowers on the conventional loan is considered a first-time home buyer by HUD's definition, they can do a minimum 3% down maximum loan, 3% down maximum LTV of 97%. So the little wrinkle here is that in the chart below, as we go across, you'll see that, yeah, we're still sticking with the $400,000 purchase, but essentially in this financed amount example, the borrower has put down 5% and then financed the one-time buyout of the mortgage insurance and rolled it into the loan. All right, so we'll kind of dissect this a little bit. But basically, this is kind of an ideal situation when the conventional borrowers have excellent credit and they actually have enough to put 5% down and they're a first-time home buyer. That's kind of the umbrella that we're operating under for this one. So what you see is the $400,000 loan amount, but the true base loan amount, if the borrower actually has enough to put 5% down, would be $380,000. Now in the chart down there, you see the loan amount says $384,560. Okay, so what we've done in the third and fourth bullet up above kind of break down this math. If the premium is 1.2% of the $380,000, that dollar amount is $4,560. So we're allowed to roll that into the loan and still be under the maximum loan to value, which is 97. So essentially, if I'm at 95% with 5% down, and then I'm going to finance 1.2%, my overall loan to value on this loan is 96.2%, which again is still below the 97% maximum loan to value for a first-time buyer on a conventional loan. So in looking at how does it compare in terms of payment breakdown, it's coming in, and you'll notice here too, and I always point this out to clients that, the PMI has very little impact on interest rate. The interest rate's pretty much driven with down payment percentage and credit score and debt to income ratio. So the borrower, even though they're putting 5% down versus 3% in the first two examples, even in this finance one, they're putting 5% down, there's no change in the rate, right? So the rate's pretty much the same at 4 3/4, but you'll see here that this kind of yields, a lower payment by what, $167 compared to the highest one, which would have been the monthly MI column. So again, this is kind of a unique thing, and a lot of most consumers don't realize this, but I find that a lot of real estate agents are not really aware that this is an option that they can do. But again, it fits. It's going to work when they've got enough money for a little bit more in down payment. And you can structure this anyway. So if the borrower, let's say the borrower says, well, I can put 7% down, and let's say the mortgage insurance premium one-time buyout was 2%. Well, that would be a 93 loan to value plus 2% for the financed MI, and then you'd be at 95. So you can do this anytime there's basically a larger down payment where you can squeeze the percentage of the one-time buyout into the loan and still fall under the maximum loan to value for the program. This could be a pretty valuable option. Okay, and I think, yeah, that pretty much concludes everything I had to share. Let's see, Dave, how are we doing on time? Right at 11.
Yeah, we're looking good. So let me get
definitely would want to open up open it up for some questions, or am I missing anything in the chat?
No questions as of yet. You guys, if you do have questions, if you could go ahead and weigh in on the chat box, that would be great. The other thing that I offered, and I just want to make sure everybody saw it, is that as a follow-up, I'm going to send this, the link, the YouTube link to Mike, and then he'll have an opportunity to follow up with you guys and send it to you for if you would like it. In other words, if you'd like to have this so you can look back at these slides, because I know this is a lot of really, really good information, but I know there's some details there that I'm sure.
It's a lot of numbers, and it's like, you'd want to almost hear the math and the walkthrough of it and how it's structured, which is again awesome that we can record this and you guys can have access it and bookmark it.
Yes, absolutely. So and so the reason I asked for emails, though, you guys, I know you registered, but the way that Zoom, this platform that we're using, shows up on here, most of you, all I have is a first name, or some of you I don't have a name at all. We just have phone numbers or names of your computers and all kinds of strange things. So if you would like this, please go ahead and send, give us your email. So, there we go. Good. Thank you. I appreciate that, Andrea. Good. Kelly, I think you did give me yours too. Kelly asked the question in there, Mike, if she can, if Kelly can have questions later, the email questions.
Absolutely.
Good.
I'm gonna put here for everyone. Feel free to email me and my email address there.
Good. Perfect. Good. So it'll all be in there. So again, you guys, please go ahead and make sure that there we go. Good. Thank you, Mike, for putting that in there. So you guys, you have his email there. So
I've got a question to the group, perhaps, if there's nothing immediate for me on the topic, but I'd be curious just kind of to see and kind of gauge whether this information today brought anything new to you. I mean, was there any, did you gain any new understanding, or was this stuff something that you felt fairly comfortable and knowledgeable with?
Oh, good. Thank you, Donald. Yeah, if this is, yeah, good. Yeah, the one-time payment was new too. You can see these now too, right, Mike? Good.
Yep. I've got
Good.
the box. Yeah. Andrea, absolutely. I mean, that's usually what I get from teaching the classes. That I get a lot of people that say, oh my gosh, I had no idea that they could kind of buy it out and just be done with it.
Yeah. Good.
Yeah. The financed option is, I've found myself, obviously it's a borrower specific, but that you can get, that idea of if they've got the money for the little bit larger down payment and then roll that back, that one-time cost back into the loan, and hey, why not finance and leverage it over the 30-year term?
Mm-hmm. Right.
Lou didn't know about the rule change and the tax savings with the higher rate. Yeah, and again, we have to say, consult the tax advisor. But yeah, there was a period of years, I think, enacted by Bush and then upheld in the Obama era, where there were certain income levels, I believe, were able to deduct some of the PMI charges or premiums. And I think that with our recent tax changes and reform, that all went by the wayside. But of course, there were a lot of changes with the last reform. Yeah, buyers, Kelly, I have buyers that simply balk at MI payments, so they decide not to buy. Yeah, it's a shame. And that's kind of, the purpose of this, educational piece is to, it's not really as bad. I always look at it, you could, you find the way to put it to them professionally and politely. It's like, well, if you could not buy and be missing out on building wealth through purchasing real estate, or you could get in the game and get, pay preferably a low PMI premium, or buy it out, be one and done. And like I said, sometimes the people have to work on they have to do some credit repair first. Do I do first-time homebuyer seminars for buyers with an agent? I do. One thing I do, if I do the VHDA, I don't know if anybody on the call here has done the VHDA train the trainer and gotten their certificate or gotten their blessing to teach the VHDA first-time homebuyers classes. I've done several of those, but definitely open to teaming up with anybody that wants to put something together.
Good.
See, Lou, would you be willing to create a short video, purchase a home with little or no money down, maybe 1 to 3 minute? Yeah, definitely. Yeah, not so technical.
Yeah.
They don't need all. Yeah, they don't need all the behind the curtain math. But yeah, I mean, that's a great idea. I would totally be up for putting something together like that for you. But yeah, that's true. It's when you're trying to convert the renter, yeah, we're told you can't go in there using all the acronyms like LTV and PMI and this and that. I think Lou, to follow up on that is you've got that's maybe to kind of combine that, since a lot of the low down payment mortgages are essentially geared towards low to moderate income household limits, that maybe kind of do a little quick video where we're introducing some of those programs like the VHDA, and they've got the grant program and the 100% financing program for first time buyers.
Mm-hmm.
And you kind of we can kind of, you know, slide in, because yeah, the PMI is part of those conventional programs. You know, whether it's borrower paid or the, as the HDA calls it, is the no MI, which is truly lender paid with a higher rate.
Gotcha. Yeah, that is a great idea. I love that. So
sounds like a good social media post video too.
absolutely. Yeah. So you guys, you
Get with
got
the
to make
times.
sure you, yeah, exactly. So make sure you check out Mike Ott's Facebook page, right, Mike? You have a business one, right?
Yes,
Yes,
it'll
good,
be
perfect,
Mortgage
good.
by Mike Ott. Yeah, Mortgage by Mike Ott.
Yeah, so check out his Facebook
And I
page.
can,
That would be a good place to post it. So
throw that up here in the chat box.
good, perfect, awesome. There we go. Let's see here. Good. Any other questions or comments, you guys, that we can help with? I think we're good, Mike.
Hey, well, let me say thank you. I appreciate it. Thanks, Dave, for being on and facilitating us. And this is actually a great segue, these questions about, you know, doing a video potentially for renters and, you know, trying to attract the first-time homebuyer client. I will be doing, if anybody's interested in the physical face-to-face class, I will be doing through Cindy Bishop Worldwide. We will be Saturday, September 7th. It's usually between 9 and 11, a 2-hour class. And on that particular date, it will be all about the latest and greatest in first-time buyer programs, and then also kind of, you know, a way to how to kind of find, develop, and nurture those relationships with potential first-time buyers. So if you please, if you're at all interested in that, would love to have you join. We do this in my First Heritage office here in Lake Ridge, and you can bring clients, Kelly. I don't think Cindy has a problem with that. I think I've had an agent bring some clients before. I mean, I'm fine with it personally, and I think what they'll do is they might find half of the presentation beneficial for them when we talk about the different offerings and programs and strategies. The other half that's more real estate, basically for you, and how do we kind of go out and, you know, lead generate and try and, you know, find and nurture first-time home buyers. They might, you know, kind of tune out for that, but I mean, I'm fine with it. They're more than welcome to join. Yeah, that'll be Saturday, September 7th. Like I said, I would imagine, don't quote me on the time, but it's usually 9 to 11. And I know that we usually get pretty decent turnout too for any of the, especially for, you know, agents that happen to be dual career, and it's tough to get on these things during the work week.
Mm-hmm. Wow. Yeah, Saturday classes, I know Cindy said have been real well attended too. So good. All right, you guys. Well, I think we can conclude this. So nice job, Mike. I appreciate it. This is really good information.
Oh.
So, you know,
thanks, Dave. Thanks for you and Cindy for having me. I'm happy to do this. I can't wait to do it again.